Hello, investors. Welcome back to Mali Investment Talks with me, your host, Joseph Areo. We've been talking about bonds. I would like to transition from that into briefly talking about the risks of purchasing a bond, especially in the environment in which we live today. If you've been following the market, you would have heard that some banks in the advanced markets collapsed. And a major reason for their collapse was the devaluation of their bonds as a result of a rise in interest rates. So I want you to understand, many times I have heard people loosely saying that, oh, bonds, especially government bonds, are risk-free. That's not necessarily true. In the context of what's going on, the interest rate environment and that kind of thing, that may not necessarily always be true. So as I said before, there are three main variables, macro variables, market variables, which determine risk to a bond. So the first one is what you would call the risk of default. The risk that the issuer, whoever sold that bond to you, could just default, go out of business or whatever. So if it's a company, then it goes out of business, it's liquidated. If it is a government, well, maybe the government just becomes dysfunctional, is unable to pay you. In the case of government bonds, that risk is very small, very, very small. Certainly in our region, that risk, if it's there, is very, very small. However, the second category of or source of risk is inflation. I talked about that in the last session. Inflation is the rate of increase of prices in the market generally. As I said, when inflation goes up, of course, number one, the value of your money is coming down, the purchasing power of your money is coming down. So that already presents a risk. But number two, it also means that now central banks are going to respond with a tightening monetary policy, which is designed essentially to try and contain inflation. They'll try to withdraw money from the market, they'll try to raise interest rates, and so all that will have potential implications for the value of your bond. As I said, inflation goes up, the price of your bond is likely to come down. So if you're holding a bond and you want to sell it, then you are going to sell it at a discount. And that may not be necessarily good news. The third factor related to inflation, as I've just explained, is essentially the interest rate environment. When interest rates go up, then the value of your bonds come down. And that was a major reason why some of the banks that I told you have been in trouble around the world, especially in the advanced economies. This was a major reason why they had problems, because what happened was that they had invested significant sums of depositors' money in long-term government bonds at a time when interest rates were low. Before COVID, interest rates were very low. So then, lo and behold, the depositors, for one reason or another, came and asked for their money back. The banks had to liquidate the long-term bonds in which they had invested in government. But guess what? because interest rates had gone up, the price of their bonds had gone down far much lower than what they paid in order to buy those bonds. So in other words, they could only sell the bonds at a significant discount, giving them much less money than they needed to get the liquidity to be able to pay out depositors who were trying to get their money out. And hence the collapse, hence the challenges that the banks found themselves in. So it is a risk that we would all want to be aware of, the risk that interest rates go up and therefore the value of the bonds that we hold comes down. Think about it this way. If interest rates are going up and you are trying to buy a bond today, the bond you're buying today has a fixed rate, a fixed coupon rate. And if it was fixed at a time when interest rates were low, it means the rate of the coupon rate was low, reflecting the interest rates at the time. And it is fixed and will remain fixed for the entire maturity. But you know that interest rates are going up. So why would you buy that bond today and keep getting that low interest rate when actually you could get your money, you could put your money in another instrument and enjoy higher interest rates because interest rates are going up over time? So that is the reason why you can only buy a bond at a discount if interest rates are going up, or someone can only buy the bond from you at a discount if interest rates are going up. So depending on when you want to redeem that bond, if you're going to redeem it before maturity, then you're exposing yourself to significant risk. But on the other hand, my advice to you, as I have done before, if possible, try to hold your bonds to maturity, and that would minimize on that risk of devaluation of your bond as a result of interest rates going up. So, three main sources of bond risks. One, default risk. That is generally very low, especially if you are dealing with government bonds, at least in our region. Number two, inflation risk. As inflation goes up, the price of your bond is likely to come down. And so when you sell it, you're likely to sell it at a loss. Thirdly, interest rates, which could go up because of monetary policy, because of inflation, because of other reasons. But when that happens, once again, you are likely to incur losses as and when you try to sell your bonds. Thank you very much for listening, for watching. I hope this was helpful. Do get in touch with me to get any further insights as you might find necessary. And indeed, do subscribe to the channel so that you can get updated on further posts. Thank you.